Hello, my name is Bachner, and I'm the Director of Financial Planning here at Summit Financial Consulting. We recently discussed monetary policy in our previous video, and this time around we are going to be discussing fiscal policy. These two policy efforts are implemented by various parts of the government, with monetary policy being controlled by the Federal Reserve and fiscal policy being controlled by Congress. However, they both have the same goal to either expand or contract the current economic environment. Fiscal policy refers to the government's ability to adjust spending and taxation to influence the economy's current condition. These are both very important measures for the government to consider, so we'll be tackling these in separate videos. This video will be focused on the taxation portion of fiscal policy, and the previous video discussed the spending side of policy. Taxation is the primary source of funds for the U.S. government to fund their agreed upon budget items. This year, in 2024, the total amount of collected taxes could be near $5 trillion. Almost half of this amount came from income taxes of the U.S. citizens, but other large sources were Social Security and Medicare taxes, and also corporate income taxes. However, the U.S. government actually still had a budget that exceeded the revenues they collected. One of our concerns is that tax rates may actually increase in the future since the national debt and the associated interest payments continue to rise. If the government ever plans on operating on a budget surplus instead of a deficit, they will need to either drastically reduce their budget or they will need to increase revenues by generating more tax dollars. Current taxes may already seem high, but the U.S. actually collects less tax dollar per gross domestic product than other developed nations. The U.S. tax revenue was roughly 27% of GDP, while the average other developed nation is closer to about 34%. This means that our country collects less tax dollars per produced good or produced service compared to other countries. However, specifically income taxes made up a larger portion of the U.S. total revenue compared to the average. This means that our additional tax sources like property or sales taxes contributed less than the average of the other countries. Deciding on the appropriate level of taxation is a balancing act for the government. They need to weigh the pros and cons of increasing or decreasing taxes. If they increase taxes, then they could likely fund a higher national budget, but there could be less consumptions by the citizens. If they decrease taxes, they could actually achieve higher consumption levels by the citizens, but will receive less revenue in return, so their national budget may be more constricted. Once again, my name is Zach Bachner from Summit Financial Consulting. Thanks again for taking the time to watch this video. If you could, please like and subscribe to our YouTube channel, and you'll stay up to date on our future video releases. We'll catch you next time.
Summit Financial,
working with people you trust.